Good morning, ladies and gentlemen. It's, as always, an honor for me to speak to you today at the 8th Insurance Conference of Insurance Europe. And first of all, I would like really to thank very much our host, Insurance Europe Ireland, for helping us to put together a day full of interesting discussion and I hope also debate. The theme of today's event is serving our customers in tomorrow's world. We choose this theme because our industry, and indeed our society, face potentially technological, demographic, and climatic shifts. However, whatever changes the future may bring, insurance needs to be able to continue delivering the valuable products and services that help our customers to lead secure and prosperous lives. So, what components need to be in place to enable us to serve our customer in the future? Overall, we need a regulation that allows us to continue to put our customer at the very heart of everything that we do. For this to happen, we need rules to be clear, simple, and fit for purpose. Unfortunately, there are numerous examples of where European legislation, despite being well-intentioned, is none of these things. Let me give you an example. To continue improving our service to customers in the future, we need a regulation that allows us to keep them appropriately informed. However, when you consider three new pieces of EU legislation, the IDD, the PRIPS, and the Solvency II, they will require a person buying an insurance-based investment product online from a broker to receive 148 different pieces of pre-contractual information. Will this help that person to understand the product they are buying? Clearly not. Especially when you realize that much of the information is duplicative, which in practice means that the customer will receive the same information several times in a different wording and format. Another example can be seen in the PRIPS regulation. This regulation provides for a key information document that is intended to help consumers compare different investment products and to gain a better understanding of their features. And we strongly support this objective. However, the current proposal of the European supervisory authorities for the design of the kit would make insurance products wrongly appear more expensive and more risky than they actually are. If the EU institutions accept these proposals, it means that the kit would actually mislead consumers. It is therefore essential that the EU institutions address these design faults immediately and get the kit right to allow for a better comparison of products and better consumer understanding and practice. Of course, to continue providing products that address our customer protection and savings needs in the future, we need a regulatory framework that both appropriately reflects our business model and takes into account of impacts on consumers. And as you can imagine, this brings me to Solvency II. European insurance have contributed a significant amount of resources and effort to its development and implementation. While it brings many significant benefits, such as improved governance and risk monitoring, inevitably, for a framework so ambitious, there are aspects of it that need to be improved. In particular, people need to understand better why Solvency II is already a very conservative regime. Adding further levels of regulatory conservatism is not the right action, especially in a low interest rate environment, which is already hurting customers' long-term savings and putting pressure on the industry. For example, there are already calls to increase the level of capital insurance need to hold even further, such as through changes to the ultimate forward rate. However, this might be a result of misunderstandings about what the UFR is and what it is used in Solvency II. Firstly, it seems that not many realize that we are discounting liabilities at rates far below the UFR. For example, the UFR is 4.2%, but the actual discount rate used for 10 years liability is less than 0.8%. In addition, not many are aware of the extra assets Solvency II requires insurance to hold, but which are not actually needed to pay claims. The main one of these is the risk margin, which has even increased under low interest rates. This is all, of course, in addition to the solvency capital, which ensures insurers can cope with a very wide range of extreme adverse events, including significant lower interest rates. While low interest rates are creating real challenges for the industry, companies have been taking actions to adapt their products, investment mix, hedges, and capital levels. Solvency II makes this a requirement for all companies, creating the need for multiple layers of buffers and protection, as well as introducing very detailed monitoring to allow supervisors to ensure that the needed actions are being taken. So, increasing capital requirements now would result in an even more conservative approach for most companies. Now, some may think, surely, setting aside more capital than is actually needed can only be a good thing, or bigger capital charges don't harm consumers. But as we all know, this is simply not correct. Excessive capital charges will, in fact, result in a direct detrimental effect on our policyholders. Let me give you a short example. If an insurer has to increase annual charges on a long-term pension product by 1 percentage point because of excessive capital charges, it could reduce the overall payout to the policyholders by more than 20% over 20 years. A fifth of the performance of someone's retirement savings taken away just because an insurance was required to set aside more capital than was actually needed. And that is not all. Excessive capital charges could have an adverse effect on the wider economy. Insurance currently invests around 10 trillion euro in the economy, the equivalent of about 60% of Europe's GDP. Excessive capital charges could mean insurance will not be able to continue to invest in a long-term way or to increase their investment into the infrastructure needed to help Europe grow. If we want our consumer savings to benefit from good, diversified investment portfolios and to live in a prosperous economy, enjoying growth, then regulation needs to allow insurance to make more long-term investment and not less. Let me be clear. The insurance industry believes that Solvency II overall remains the right approach, and there is no desire to move away from risk-based regulation. We also acknowledge that the European Commission's Capital Market Union initiative has already made some much-needed improvements to capital charges, particularly in some areas of infrastructure investment. Nevertheless, it remains vital for capital charges to reflect the real risk insurance face. Therefore, it is important that policymakers use the review process built into Solvency II to make these much-needed adjustments so that the framework can fully work as intended and to avoid damaging our industry, our customer, and the wider economy. Looking to the global regulatory arena, development of the Global Insurance Capital Standard, ICS, is continuing. Unsurprisingly, some of the key areas of intense discussion are very similar to what we experienced during the development of Solvency II some years ago. As I said, the industry remains very supportive of the Solvency II framework, but it also acknowledges that some element of it, especially linked to the long-term business, need improvement. I believe all European stakeholders, industry, regulators, supervisors, should engage in this international discussion and use the knowledge and experience that we have acquired from our development of Solvency II to avoid outcomes that we already know are not optimal. From a European perspective, it is also important that Solvency II, or even an improved version of it, is recognized as an appropriate implementation of the ICS. While these issues may seem like technicalities, they go to the very heart of our ability to provide the products that our customers require. So, how can policymakers avoid the kinds of unintended consequences that I have outlined so far when designing regulation? Insurance Europe is calling on policymakers to adopt a genuinely consumer-centric approach to regulation. To achieve this, we believe that they should first address the cumulative impact of this proposal to delete duplication and clarify contradiction. That would include looking not only at level 1, but also level 2 and level 3. Second, address the complexity of the existing rules. And third, focusing on the real rather than perceived need of a customer. Finally, making sure that each new proposal delivers its expected benefits to consumers in practice. This would put consumers really at the heart of regulation and help insurance to continue improving their service to customers in tomorrow's world. Let's go shortly to digitalization. Again, looking into the future, it is important to recognize that in order to serve our customers in the future, we must embrace digitalization. Digitalization is already reshaping the way insurance innovate, distribute, underwrite, compete, and interact with the customers. However, we should be careful with the assumption that digitalization could be the answer to overcoming all barriers to insurance cross-border businesses, as implicitly suggested by some policymakers. One of the key questions for policymakers around the world would be to ensure that their respective regulatory frameworks are digital and tech-proof. Regulation needs to make sure that standardized information sheets, which should help consumers compare products, will be available in size, format, and content that can be accessed by digital means. But notwithstanding the opportunities that the new digital tools are bringing, there will be always elements like culture, tax systems, infrastructure standards, and labor markets that will continue to remain different, and only changing the operational mode from paper to digital will therefore not solve all problems. Another aspect of digitalization is who owns the data. Let's take the example of highly automated and connected cars. By having access to more granular data generated by their customer cars, insurers can offer many new products and services. However, for this to happen, policyholders must remain in control of who can access the data so that they can decide whether to provide it to a range of service providers, including insurance. And this decision should not be made by the car manufacturers. At the same time, it is also vital that our industry continues to support non-digital consumers who may find it difficult to use new digital services. With that in mind, regulatory initiatives should not favor one channel over the other. Ultimately, consumers must be able to choose which means they wish to use to access insurance products and services. Traditional paper-based and modern digital-driven distribution must both remain possible to avoid excluding customers from accessing the product they need. And let's come to the conclusion. So, what can you take away from the conference today? What do we need to do to ensure that we can continue to serve our customer in tomorrow's world? First, we need regulation that is truly customer-centric, that responds to the real needs of customers and that delivers real benefits without duplication and without contradiction. Second, we need regulation that accurately reflects the risk our industry faces, so that while it protects policyholders and taxpayers, it also allows us to continue to invest in our economy and provide the important products our customers demand. And finally, we need regulation that takes account of the opportunities in our future, but does not forget the important tradition of our past. It needs to be both paper and digital proof. And of course, good regulation requires a deep understanding of the insurance business and its characteristics. In order to achieve the best for our clients without causing unnecessary burdens and unintended consequences, a steady and trustful dialogue between regulators and the insurance industry is needed now more than ever. To maximize the benefit of this engagement, our industry must continue working together as we do through Insurance Europe, which, remember, represent not just the interest of one single company or one single group, but of the entire European insurance industry, encompassing companies of all kinds, whether they are large, medium, or small. And this is very important, because we need regulation that allows our whole industry to continue to be part of the solution to many of society's most serious challenges. By standing together, we can ensure that regulation will allow insurance not just to stay where we are now, but to contribute even more in the future. Thank you very much, and have a nice conference.